Good morning, learners. In today's lesson, I'm going to look at the cash flow. Now, this has become a very important question for the grade 12s and something that you need to focus on because there will always be some aspect of a cash flow. Now, in this first lesson today, I'm going to look at a complete cash flow. But what you need to be aware of is that in the examinations, often they only ask you parts. Right, so let's start looking at it. We know that we've drawn up already an income statement or a statement of comprehensive income where we work out what profit we've made. We do a balance sheet or a statement of consolidated financial position in which we work out what our financial position is, looking at our assets, our liabilities, and our owner's equity. But a third and very important part of it is the cash flow statement. The cash flow statement looks at your cash. Now, in ratio and analysis, you've already looked at liquidity and is it a liquid. Now, when we're looking at the cash flow, then we're looking at our cash that has come into the business and our cash that has gone out of the business. Very much like when you looked at your cash receipts and cash payments journal back in grade 9 and grade 10. So we look focusing on that, but we're not drawing up journals. We are summarizing those inflows and outflows of cash. Because if you have a look at your balance sheet here now, you'll see that in the balance sheet, under cash and cash equivalents, which is an asset to you, you had 45,000 last year, and you've only got 1,250 this year. So you can see that your cash has gone down. On top of that, and this is very important, you need to have a look down the bottom and connected with that, you know that if you go into a negative cash situation, you go into a bank overdraft. So you can see that your cash situation has gone from a 45,000 positive last year to 1,250 in the bank account. That's probably your cash float or your petty cash. And you're sitting in an overdraft situation. So there's been a reduction in cash in this business. And what we want to do is be able to account for why there's been this reduction. So therefore, the first thing we're going to do in the cash flow is to put these figures in. And so at the beginning of the year, remember, 45,000 and there was no overdraft. So your cash flow statement, the bottom of your cash flow statement, and I'm going to look at this in greater detail now, but your bottom of your cash flow says, what was the cash and cash equivalents at the beginning of the year? And at the beginning of the year, we had a positive 45,000. But by the end of the year, while we had an overdraft of 57,960, we do have 1,250 in the bank account. So we need to get a net figure of that. So we had a negative 57,960. Minus off it the 1,250 that we do have in the petty cash account that can serve to pay off some of that overdraft. So you've actually got 56,710. And I want you to take note that I've put that into brackets because it's a negative situation. So you have gone from 45,000 positive to 56,000. So what has happened during the year is there's been a reduction. Now, the easiest way to explain this is if you go back to your maths and go back to your number line, and let's say there's naught. Now, you've gone from 45,000 positive all the way down to negative 56,710. So you spent this whole 45,000 and you spent another 56,000. So your cash has reduced by 45 plus 56. And that's important that you see that first concept. You've gone down. So because I've gone down, the change in cash and cash equivalents this year is going to be a negative because I've gone down. I've lost my 45,000. I've spent it. I've spent another 56,710. So I have reduced my cash by 101,710. And that is what the cash flow is going to do now. You're going to say, right, the shareholders, the directors are going to say, right, your cash has gone down. But why? You've got to account, there we're back to the word account, accounting. We've got to account for this reduction in cash. Now, when we report on this reduction in the cash, we report under 3 main headings. The first one is the operations of the business. That's what the business is doing. That's why they're in business. They are buying and selling goods. They're paying their expenses. They're paying their income tax. And it's the day-to-day operations of the business. So there'll be some cash flow from running the business. Secondly, there could be a cash flow from investing. Now, you will probably immediately think of investing as fixed deposits, which is correct. That is an investment. But it goes further than that. We also invest in our fixed assets. We invest in land and buildings. We invest in vehicles. We invest in equipment and other assets so that we can run our business and generate a profit. So the investment in fixed assets is part of investing. Yes, some of them will hopefully grow, like land and buildings, whereas vehicles and equipment will decrease in value. But you invest in those assets in order to help you generate a profit. And then the third section of this is your financing. How do you finance your business? And as cash flow comes in under companies with us at school, we can finance our business in 2 parts. We can sell shares or we can take out a loan. So we'll look at the specifics of each of those in a minute. But so just get an outline of the cash flow before we even start. So we've realized there's been a reduction in cash, and we've now got to account for that under what happened under operating, the running of the business, what happened in investing, and what happened under financing. So try and get that big picture first, so that you can see the purpose of what you're doing before we look at specific details.